Everyone is talking about inflation and rising interest rates.
Increase in 1 year inflation.
8.6% inflation.
Going up at the fastest rate for 30 years.
The Federal Reserve is expected to announce another round of interest rates hikes.
Higher interest rates and slower output growth.
But how likely is it that prices will keep on rising at these crazy levels? And what does it mean for you personally? In this video, I'm going to break it down really simply into what inflation is, how central banks try to control it, a scary comparison to the late 1960s, where we are now, and what it means for you personally. So first, let's define what inflation is. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. In simpler terms, it means that the same amount of money can buy you fewer goods and services than it did before. There are several factors that can cause inflation, including an increase in demand for goods and services and a decrease in supply. So when there's too much money chasing too few goods, prices go up. So how they measure inflation is actually quite interesting. So they take a typical basket of goods and services and they compare the prices from month to month. So this is a group of around 750 items in the UK, including things like bread, milk and vegetables, to things like taxi fares, swimming pool admissions and hairdressing fees. So imagine you go to the supermarket to buy all of these exact same products every month, and then you compare the price that you paid last month to this month, and that is the rate of inflation. So they actually update the basket from time to time as typical products change. So recently they got rid of cigarettes, alcopops, CDs, and they added in frozen berries and e-bikes. So how do central banks control inflation? When prices are increasing too quickly, it can cause issues as people's purchasing power decreases if their wages don't increase as much, meaning that people can't buy as much stuff. And this can also lead to uncertainty and impact economic growth. So ensuring that inflation doesn't get too high is essential. And what you really don't want is hyperinflation. This is where you end up needing to pay for things with wheelbarrows full of money. So central banks have the task of maintaining this price stability, and one of the tools they use is interest rates. So when inflation is too high, central banks can raise interest rates to discourage borrowing and spending, and also encourage saving, which can help bring inflation down. So if an interest rate on a bank account is higher, you're more likely to save that money rather than borrow money and spend more. The real issue is when inflation is high and the economy is stagnant. So increasing interest rates might solve the inflation issue, but negatively impact the economic growth issue. So this brings me on to the limits of interest rate policies. And one scary example is what happened in the late 1960s and the parallels to today really. So during this time, the US experienced high levels of inflation due to a combination of factors, including government spending on the Vietnam War and the oil crisis. And during this time, inflation was particularly sticky. So in the late 60s, as inflation was increasing, they'd bump up interest rates. But as soon as they started dropping them again, inflation would just get out of control. And there was this sort of seesawing, so inflation just stuck high. So this period of high inflation is known as stagflation, which is a combination of the stagnant economic growth and high inflation. Now let's fast forward to today. Over the last 14 years or so, we've had low inflation and so had really low interest rates. And this has led the stock market to rocket, growing over 5 times the size since 2009. In fact, some argue that the low interest rates have contributed to the current inflationary pressures by encouraging borrowing and spending and fueling the asset price bubbles. Potentially a similar situation to what we had in the 1950s and early 60s prior to this boom in inflation. So central banks are now facing a delicate balancing act of trying to support economic recovery without overheating the economy and causing more inflation. So this feels fairly similar to what happened in the late 60s. So let's see what happens there. I don't think it's going to be exactly like the 70s, but it's a scary parallel to look at. So this finally brings me on to my prediction for future interest rates and what it means for you. I personally think inflation will be stickier than everyone had hoped. And so interest rates will need to stay higher longer than was expected. A few months ago, people were expecting interest rates to start dropping in the second half of 2023. However, it's looking way more likely that they'll only peak then, with the earliest reductions in the first half of 2024. So this can impact you in several ways. Firstly, purchasing power will decline if you don't get pay rises in line with the inflation. So with the same money that you receive from your salary, you'll be able to buy less stuff because stuff is more expensive. Secondly, cost of living will increase, so rents, utilities, general food will be more expensive. So it can be more difficult for some people to afford basic things. And we've seen some of this already. And thirdly, there will be more uncertainty in investments. So house mortgage rates are higher because of higher interest rates, and I think these will stay high until next year at least. So it'll be harder to buy a house or keep up with the mortgage payments. Having said that, that may cause the housing market to drop a bit. And then also stock market investments. Because interest rates are still rising, it means companies pay more for debt, so they earn less money. So stock prices generally fall. This uncertainty also causes instability in the markets, and stock prices can move around a lot. And I personally think this is going to impact the markets for the rest of the year, and 2024 may be the time to start buying back in. And lastly, saving can be more difficult because purchasing power is down and cost of living is up. And this means you need to be more disciplined in your approach to saving. So check out my next video on the best ways to save money and feel good about spending when you do. Thanks for watching, and see you soon for more.